Ever dreamt of getting rich quick? It's a tantalizing thought, isn't it? The idea of waking up one day to find your bank account overflowing with cash, all because of a few smart decisions. Picture this. You buy a stock for cheap, it skyrockets in value, and suddenly, you're swimming in cash. It's the kind of story that fuels dreams and keeps people glued to their screens, watching every tick of the market. This is the seductive promise of the stock market, whispered in hushed tones and plastered across flashy websites. Advertisements and success stories make it seem like anyone can do it, like it's just a matter of picking the right stock at the right time. But here's the catch. If it were that easy, wouldn't everyone be doing it? The reality is far more complex. For every success story, there are countless tales of disappointment and loss. The truth is, the stock market is not a get-rich-quick scheme. It's a sophisticated system that requires knowledge, strategy, and often a bit of luck. Many people dive in headfirst, only to find themselves overwhelmed by the intricacies of the market. It's a complex beast, capable of generating immense wealth but also capable of inflicting devastating losses. The market can be unpredictable, and even seasoned investors can find themselves caught off guard by sudden downturns. Before you dive headfirst into the world of investing, it's crucial to understand not just the potential rewards, but also the very real risks lurking beneath the surface. It's not just about picking winners, it's about managing risk and knowing when to cut your losses. So buckle up, because we're about to take a wild ride through the exciting, treacherous, and often downright baffling world of the stock market. It's a journey filled with highs and lows, where fortunes can be made and lost in the blink of an eye. Are you ready to navigate this thrilling landscape? Let's dive in and explore the realities of investing beyond the allure of easy money. At its core, the stock market is where companies go to raise money. They do this by selling shares of their company to the public. These shares represent small pieces of ownership in the company, and investors go to, hopefully, make money by buying these shares. The idea is to buy low and sell high, making a profit in the process. Think of it like a giant flea market, but instead of used furniture and vintage clothes, you're buying and selling tiny pieces of ownership in companies. Each company has a different value, and that value can change over time. These pieces of ownership are called stocks, and their value can go up or down depending on a whole bunch of factors. These factors can include the company's performance, the overall economy, and even global events. But here's why the stock market matters to more than just Wall Street hotshots. It plays a vital role in the economy. When companies raise money through the stock market, they can invest in new projects, hire more employees, and grow their business. When the market is doing well, businesses grow, people get jobs, and everyone feels a little richer. This can lead to more spending and investment, which further boosts the economy. But when the market tanks, it can trigger recessions, unemployment, and a whole lot of economic anxiety. People lose money, businesses struggle, and the economy can come to a grinding halt. So yeah, the stock market is kind of a big deal. It's not just a playground for the rich and powerful, it affects everyone in one way or another. But before you start picking stocks willy-nilly, let's take a quick trip back in time to see how this whole thing got started. Understanding the history of the stock market can give you a better idea of how it works and why it behaves the way it does. The concept of the stock market dates back to the 1600s, when the Dutch East India Company issued the first shares on the Amsterdam Stock Exchange. This allowed investors to buy a piece of the company and share in its profits. Over the centuries, stock exchanges have evolved and spread across the globe. Today, major stock exchanges like the New York Stock Exchange and NASDAQ play a crucial role in the global economy. So, as you can see, the stock market has a rich history and a significant impact on our lives. Whether you're a seasoned investor or a complete beginner, understanding the basics of the stock market is essential for making informed financial decisions. Believe it or not, the stock market has been around for centuries. One of the earliest examples, the Dutch tulip mania of the 1630s. People went bonkers for tulips, driving up prices to insane levels before the bubble burst, leaving many financially ruined. Sound familiar? Fast forward a few centuries and we have the Roaring '20s, followed by the devastating crash of 1929. More recently, the dot-com bubble of the late 90s saw investors pouring money into internet companies only to watch many of them go bust. The lesson here? The stock market is a fickle beast, prone to booms and busts. Understanding its history can help us avoid repeating the mistakes of the past. Alright, let's get down to the nitty-gritty of how this whole stock market thing actually works. The stock market can seem like a complex and intimidating place, but once you break it down, it's really just a system of buying and selling ownership in companies. Imagine you want to buy a share of Apple stock. This share represents a small piece of ownership in the company, giving you a claim on part of its assets and earnings. You can't just stroll up to Tim Cook and hand him a wad of cash. The process is much more structured and regulated to ensure fairness and transparency. Instead, you need to go through a broker, which is like a middleman between you and the stock market. Brokers facilitate the buying and selling of stocks, making it easier for individual investors to participate. Brokers can be traditional brokerage firms with physical offices and financial advisors, or online platforms like Robinhood that allow you to trade stocks from your smartphone. Once you've got your broker set up, you can place an order to buy or sell stocks. This order specifies the number of shares you want to trade and the price you're willing to pay or accept. These orders are then matched up on stock exchanges, which are basically electronic marketplaces where buyers and sellers come together. The New York Stock Exchange and NASDAQ are two of the most well-known exchanges in the United States. It's all very high-tech, but the basic principle is simple: supply and demand. The price of a stock is determined by how much people are willing to pay for it and how much sellers are willing to accept. When more people want to buy a stock than sell it, the price goes up. This is often driven by positive news about the company, strong earnings reports, or overall market optimism. And when more people want to sell than buy, you guessed it, the price goes down. This can happen due to negative news, poor financial performance, or broader economic concerns. Understanding these dynamics can help you make more informed investment decisions. Now for the part you've all been waiting for, the dark side of the stock market. Remember that get-rich-quick fantasy we talked about earlier? Well, it often attracts some shady characters who are more than willing to bend the rules and sometimes break them to make a quick buck. We're talking about insider trading, where people with privileged information about a company use that information to buy or sell stock for a profit. Or market manipulation, where big players try to artificially inflate or deflate stock prices to their advantage. These illegal activities can rig the game against ordinary investors, making it even harder to succeed in the market. And let's not forget about those pesky economic crashes, which can wipe out even the most well-diversified portfolios. So how do we protect ourselves from the dark side of the stock market? Well, for starters, we need strong regulations and enforcement to crack down on illegal activities like insider trading and market manipulation. Technology can also play a role in leveling the playing field. Algorithmic trading and high-frequency trading can be controversial, but they can also make the market more efficient and transparent. But perhaps the most important thing is to be a smart investor. Do your research, diversify your portfolio, and don't put all your eggs in one basket. And remember, if something sounds too good to be true, it probably is. Congratulations! You've just completed a crash course in the stock market, from its humble beginnings to its complex present and uncertain future. But this is just the tip of the iceberg. There's a whole world of information out there about investing, trading, and everything in between. Don't be afraid to do your own research, talk to financial advisors, and learn from your own experiences and mistakes. Remember, the stock market can be a powerful tool for building wealth, but it's not for the faint of heart. Approach it with caution, a healthy dose of skepticism, and a willingness to learn, and you'll be well on your way to navigating the exciting, terrifying, and endlessly fascinating world of investing.